Every tax strategy the rich use explained in 5 minutes. First, an uncomfortable truth. The rich don't avoid taxes by breaking the law. They avoid taxes by understanding the rules better than everyone else. Taxes are not just a bill you pay once a year, they are a system. And like every system, they reward those who learn how it works. Most people see taxes as punishment for success. The wealthy see taxes as a design problem, income versus wealth. This is the most important concept to understand. Employees earn income. The rich build wealth. Income is taxed heavily, immediately, and repeatedly. Every paycheck gets hit before you ever touch it. Wealth grows quietly, often invisibly, and it's usually taxed lightly much later, or not at all if structured correctly. The goal isn't just to make more money, it's to make money that isn't classified as income. That single distinction changes everything. Paying yourself in assets, not salary. Salaries are the worst way to get paid from a tax perspective. They're taxed at the highest rates. They trigger payroll taxes, and they offer no protection. Assets work differently. Stocks, businesses, real estate, they don't just pay you, they appreciate. The rich structure their lives so their net worth grows mostly through asset appreciation, not paychecks. Value increases quietly. Taxes stay dormant. The capital gains advantage. When assets are held long enough, profits are taxed as capital gains instead of ordinary income. Capital gains rates are almost always lower, sometimes dramatically lower. This is why long-term thinking isn't just wisdom, it's tax strategy. Impatience gets taxed, patience gets rewarded. Buy, borrow, die. One of the most powerful strategies in the system: first, buy appreciating assets. Then, borrow against them instead of selling. Loans are not income, so they aren't taxable. You live off borrowed money while your assets continue to grow. And when those assets pass to heirs, many taxes disappear through step-up rules. This isn't cheating. It isn't a loophole. It's a core feature of the tax code. Business ownership. Businesses are not just income generators, they are tax filters. Expenses reduce taxable income: travel, meals, vehicles, offices, education. What employees pay with after-tax money, business owners often deduct before taxes. This doesn't mean fraud, it means structure. The rich don't earn income first and then ask how much tax they owe. They earn income through entities that decide how taxes apply. Real estate depreciation. One of the most powerful legal tools available. Real estate produces income, but depreciation allows owners to report paper losses. You can collect real cash while showing a loss on paper. That loss can offset other income. You make money. But the tax system says you didn't. This is why real estate remains a cornerstone of wealthy portfolios decade after decade. Tax-deferred accounts, 401ks, IRAs, Roth accounts. The rich don't ignore these just because they're basic. They maximize them. Why? Because compounding works best when taxes stay out of the way. Every dollar not taxed today becomes many dollars tomorrow. Roth strategies. Pay tax once, never again. Roth accounts grow tax-free. Withdrawals are tax-free. The rich often prioritize Roth strategies early when income is lower and tax rates are manageable. Then they let time do the heavy lifting. Certainty beats guessing future tax laws. Loss harvesting. Losses aren't always bad. When markets fall, the rich sell strategically to realize losses. Those losses reduce taxable gains elsewhere. The portfolio stays invested. The tax bill shrinks. Losses stop being emotional. They become tools. Trusts and estate planning. Taxes don't end at death unless you plan. Trusts allow control, protection, and tax efficiency across generations. They're not just for billionaires. Estate planning isn't about dying rich. It's about not destroying wealth when you do. Location arbitrage. Where you live matters more than most people realize. Different states, different countries, different tax systems. Some people move for weather, others move for efficiency. The rich treat geography as part of strategy, not coincidence. Philanthropy with structure. Charity can be generous and strategic. Donor-advised funds, private foundations, donating appreciated assets instead of cash. The rich give money away while reducing taxes legally. Impact and efficiency are not opposites. The final reality: the tax system is not neutral. It rewards ownership, it rewards patience, it rewards structure. Most people overpay taxes not because they earn too much, but because they earn the wrong way. The rich don't hate taxes. They don't fight the system. They learn it, and then they plan around it. I'll be making more videos like this soon. Subscribe to see them.